Welcome to the Turnaround Podcast with your host, Stephen Phillips. In each episode, Stephen speaks to experienced practitioners who discuss their careers, key moments, challenges, and lessons learned in financial turnarounds and business restructuring. Join us as we unravel the secrets to turning struggling businesses into success stories. You can find this show on all the major platforms, including YouTube, LinkedIn, Facebook, Apple Podcasts, Spotify, and on our website, frilibertas.com. Now, here's the host of the Turnaround Podcast, Stephen Phillips.
I'm delighted to welcome Nick Kitchin to the show. Nick is Managing Director, Head of Lending and Transaction in the EMEA region at Gordon Brothers. Nick is responsible for capital strategy, origination, structuring, and executing investment opportunities in the United Kingdom and Europe. He has over 15 years of experience in restructuring, finance, distressed investing, and M&A. Prior to joining Gordon Brothers, Nick was a senior investment manager at global investment and advisory firm, where he reviewed and assessed investment opportunities within distressed corporates. He previously worked on restructuring teams at EY and Cooper Parry, supporting accelerated disposals, contingency planning, and insolvency. Nick, welcome to the Turnaround Podcast.
Thank you
so much for joining us.
Yeah, no, thank you. Thank you for having me. It's great.
Well, first of all, we'll get into Poundland a bit later, but I'm so glad that I'm welcoming you at a time where you're executing one of your more interesting deals. So we'll talk about that later. But to kick off, Nick, can you just give us a little overview of your career so far?
Yeah, so I, as many people know, I'm just a simple restructuring guy. So I started a Midlands firm called Cooper Parry in their restructuring team, where I got my chartered accountancy there. I was there 3 years and then left to join EY, where I was in their restructuring team for 3 years as well. Dealt with a sort of decent sized insolvencies like Dreams. Was on Nortel for a stint as well, and then Von Essen Hotels, which was a very interesting hotel chain sale. And then I joined Hilco Capital. So Hilco Capital, one of the very, very similar shop to Gordon Brothers, special situation investors. I was there for 9 years. More latterly, I helped on the restructuring of Homebase, as well as numerous other different things, and then left Hilco Capital and joined Gordon Brothers, where I started as managing director, and then was lucky enough to have an opening within the wider business and became head of lending and transactions 2 years ago. So I now lead the team here.
Fantastic. And when you look back at some of those experiences, were there any restructuring deals that sort of made you think, wow, this is why I'm in this. I want to really carry on doing this? Yeah,
I was extremely lucky, right? I did maths at uni, and I firmly believed that I would never become a chartered accountant. But my dad, nepotism isn't dead. My dad gave me an opportunity to speak to a guy called David Brayson, who was he was just a solo IP insolvency practitioner around where we lived. And I'll always remember it was a very small lawnmower retailer. So one site, which unfortunately just gone into liquidation, and sort of wandered into this site with David as a snotty-nosed 21-year-old, effectively, and watched this guy cut a deal with the landlord in relation to staying in the site for a period, effectively manage the sell out of all the stock in the business during the period and collect out money for the bank. And I thought, my word, this is actually quite interesting. So that's how I sort of started and sort of realised that actually, insolvency and restructuring, whilst not seen as the sort of really I'd say sexy side of the business, actually is really, really interesting. And there's a huge amount of nuance and commerciality and complexity associated with dealing with those situations. So as soon as I did that, I moved into Cooper Parry, lucky enough to join Tyrone's team. And from then on, I can safely say that I've thoroughly enjoyed the work that I do throughout my entire career today.
Yeah, and I think the ability to count is quite helpful. So your maths degrees, does it come into play at all?
No,
Really?
not really. I mean, my wife kills me, but I'm actually not that good a mathematician. Just generally, I'm very good at learning exams and exam results and working out what solutions are and remembering them, which actually in restructuring is probably quite a good thing just generally, because there's only, whilst there is certain nuances to each one, and that's part of the key, there is only so many junctures that you can go down, basically. So I'd say I'm not the greatest mathematician, so I wouldn't be relying on me to do any actuarial or like statistical work just generally.
Fair enough. Now let's talk about Gordon Brothers, because I think it's I think within the industry, certainly in London, a lot of people would have heard of it, but I think outside of a sort of slightly rarefied restructuring turnaround professionals, I'm not sure it's that well known. So maybe you can sort of give it a plug and explain what it is.
Yeah, so Gordon Brothers it's a really interesting business. It's a 120-year-old business. Originally started in the States as it was originally a really bad jewelers. It was a jewelry chain which unfortunately went into insolvency, and the owner, one of the Gordon Brothers, came into the business and watched the auction happening in relation to the jewelry, and realised they were doing such an awful job in relation to the auction that he decided he'd probably do a better job. And from that moment, he sort of realised that actually there's, a flair and a huge amount of complexity around, selling out stock, specifically in liquidation. So, the Gordon Brothers, we're asset experts. We do more than 9,000 valuations a year. We've got over 1 billion funds under use. We sell over 200 billion of assets just generally globally. So we really know assets. So the way I always describe it is there's 3 tiers. So you've got the valuation side. So effectively that's the sort of nuts and bolts fit. We do valuations for lenders, private equity, insolvency practitioners, etc. So that's written reports. It's a very normal standard process. In addition to that, you've then got the trading arm, or what we call the trading arm, which is effectively the side of the business which sells the asset. So really good example would be we've got an office in Dubai which buys and sells it's yellow iron, so big tractors and stuff, buys it in South Africa to sell it in Australia, just because we understand the markets. And we do that across all asset classes. So if it's something which is tangible, that's something that we can deal with. And then you've got the lending and transaction side of the business, which is obviously where I sit within EMEA. Where we basically just leverage on all the experience that we have from a valuation and a trading perspective, and we just basically times it by a number. As I say, I'm a mathematician, so it's pretty easy for me to times it by 85% or 70%, depending on what the asset class is, and then deal with it. But that's why we can lend specifically into situations which a lot of people won't do, is because we've got comfort. And if anybody's had the misfortune of being on a call with me in relation to a potential lend, we tend to focus on the worst side, the worst case analysis, because that's the way that we underwrite all of our sort of loans and putting money out. Which is leveraging all the experience that we have within the business from a valuation and also from a trading perspective. So that's us in a nutshell. We're a global firm. Predominantly it's US, EMEA. We look at a lot of the regions in EMEA, but it depends on the jurisdiction specifically in relation to the legal side, and then also we're out in APAC as well.
Got it. And are you regulated? I mean, could you describe yourself as a bank?
No, we are not. No. We're not regulated. So similar to a lot of the private credit funds and things like that, we are not a regulated lender. So there's certain jurisdictions, France being an example of it, where you need lending licenses, where we can't deploy capital.
And do you ever kind of sit in participations, for example? So where you're not allowed to lend on, do you sort of buy participations in in other jurisdictions?
We don't tend to buy participations that much. We're happy to participate in deals. So really good example of the work that we do is that if you've got a bank which is lent up to what it sees as its limit, then we're happy to come in behind that bank potentially to provide additional liquidity into the business and allow hopefully allow a turnaround. So that's where we can sort of sometimes play. I mean, it's available within the court docs. We're on Poundland. There is some upside in relation to the secured debt that Pepco have in place that we get, but that it really depends on the deal, that sort of stuff, whether there's a sub participation or not that we get benefit from.
Okay, and so we've talked about the fact that you're sort of asset focused. So can we talk a little bit about techniques? So will you be solely a lending focused? Are you equity focused? What is your modus operandi in terms of getting exposure to assets?
Yeah, so I mean, as I say, like our principal focus is on a downside basis, so making sure in a worst case scenario where we're covered. So from that perspective, we are effectively looking to be secured against all funds that we're looking to put out primarily. So that's the way we look at things. So Poundland's a good example where I think it's well documented. We bought Poundland for £1, so principally there was no equity value in relation to that. We're obviously providing a considerable working capital facility in the guise of a 60 million facility, which then will grow up to a 90 million pound facility. Again, the reason we can do that is because we've got the understanding around the assets, specifically around the inventory in that one. Where we have comfort in relation to what in a worst case scenario, and hopefully this doesn't happen, but in a worst case scenario, then we'll be able to collect out through the inventory through our secured debt.
And I guess what you're certainly in the UK, you'll be taking a all singing, all dancing debenture. And in a worst case scenario, what does that give you?
Yeah, so in a worst case scenario, obviously you've got the fixed and floating charge, so you've got the ability you've got qualified and floating charge. So depending on what the directors decide to do, then you've got the ability to appoint an administrator. Obviously, the administrator has a duty to all creditors, but also the secure creditor is one of the key elements in the waterfall. So you've got the ability to control elements of the process just generally. That's where we like to be. It's the same as all private credit, and to be honest, all banks just generally. The UK market specifically is a really good one just generally for ABL lenders. It's not like things like Spain or France or Italy where there's an inability to get control over the assets for the secured lender. It's very clear.
Yeah. So just to remind the audience in a way that as a result of you having a qualifying floating charge, you get to decide who the identity of the administrator is. The administrator will go in, has a duty to all creditors, but essentially you'll be at the top of the tree in terms of recoveries. But so I've talked about we talked a little bit about what happens when things go wrong, but you probably don't want that to happen. So
we're really lucky over the last sort of I'd say during the course of this year, so 2025, we've actually had a couple of refinances, which is exactly what we want within Gordon Brothers. So we've had Zavi.com, which is a deal particularly close to my heart. So that was a carve out from the Hut Group. We supported Adam and Lee in relation to their MBO to take it out of the business. They've now got a facility with HSBC. So they've gone from strength to strength. Those guys, obviously, at the initial days of the carve out, I think there was a decent amount of uncertainty about how it would go. Whereas now they've got a business which has performed now for 2 years. continuing to grow, continuing to provide other revenue sources, and it's great to see those guys move on to sort of normal lending as it was.
Yeah.
Similarly, we've just had French Connection as well. That's just refinanced as well with HSBC. So again, it's nice to see that go to a sort of more regular banking home. And then separately, we've also got Myers, which is a large department store over in Australia, which has also just gone to sort of more normal lending lines, basically. So, I mean, the way I see Gordon Brothers ideally is that we're happy to step into businesses when there's distress and when other people won't be able to do, backed by the assets. But then hopefully what the business does is it turns a corner, like it has done in Zavi's and French Connection and Myers and etc. And you get some appetite back from the wider lending community, and then they come in, step in, and refinance us out. Those are the sort of things I'd really like to see happen more often than not.
Well, you're obviously not a charity, though. I mean, if you're getting refinanced out,
and that's the other reason why people tend to want us out, because our charges tend to be, well, they range anywhere between like 7 to 12% plus base. So we're an expensive lender. I mean, there's no two ways about it. But that's obviously dependent on the situation more than anything. So,
and do you typically always get some kind of equity upside as part of your original lending?
Really depends. Really depends on the situation. So sometimes no. So another example I would give is Modus, which was actually the first deal I ever did when I joined Gordon Brothers. So they do underwater drones. So we provided them with, it was only a 6-month facility, ended up extending it by another 3 months because they were exploring sales options. And then they ended up getting sold to a business owned by Polis, which are a private equity house. So in that instance, there was no equity or anything in relation to that. In relation to Zavi, there was a very small warrant in relation to it, just because obviously we were funding the vast majority of the payment out. But it really depends on the situation.
Now let's move to discussing the current investment climate in Europe, EMEA. I mean, is this a good climate for you? I mean, somewhat low growth, unemployment ticking up around Europe. You've got Trump doing what Trump's doing. Is this good, bad? Are you thinking there's going to be a lot to do in the next 18 months?
Yeah, I mean, we're incredibly busy. Probably no surprise to any of the audience. I think the key thing here is there's so much uncertainty just going around, and there's a lot of headwinds. Specifically in the UK, you've got movements in NI. Predominantly the UK is a service-led sort of country, so that knocks onto everything. In relation to that, because the personnel costs are a big part of that. So any movement or increase in relation to the overall cost of that knocks onto businesses. You've obviously got huge energy issues as well. So specifically in Germany, there's real problems there. Just specifically in the manufacturing sector, where the government, I think, has done a really good job trying to shelter the economy in relation to the energy costs, but that won't last forever, and bluntly, there's not that much margin in relation to this. You've obviously then got a huge amount of inflation going on globally. Tariffs is obviously a big part of that, and then we'll have knock-on implications, I've no doubt, for the next couple of years, certainly while Trump's in office. So I think unsurprisingly, it's a very, very busy time for us. I think the problem that you've got at the moment is there's just no ability to forecast sensibly at the moment. It seems like every single day you look at the news and there's just another big issue that comes out, whether it's Iran, more news in the Middle East or something like that. There's just an incessant devaluation in relation to issues. So it's a tough market out there, and that's why, from our perspective, I know we're expensive, but that's why we're reasonably straightforward, because we just look at things on an asset basis, and just understanding those specific markets. So actually, from a due diligence point of view and a sort of complexity point of view, it's actually a reason that we're not talking about EBITDA multiples and things like that. We're focusing down into the actual boot collateral, the collateral of the business, which is by definition normally tangible.
Yes. Yeah. So your sectors are going to be retail?
Yeah.
What else?
Manufacturing, basically anything with logistics. We're also happy. We've got some large fleets that we lend into, both in Australia, or used to lend to in Australia, but also in the States as well. I haven't done that much in Europe, but that can change. And anything where there's sort of a heavy asset base is something that we're able to help with. The other thing I'd be remiss to mention, and Tobias would be very annoyed with me, who's head of brands, is that we also lend into brands as well. So there's various different brand loans that we have. Mothercare is a good example, which is a listed UK entity. We lend directly against the brand on that one, as well as some other assets, but predominantly it's a brand lend. So that's something where we can sort of push the boundaries to what normal lenders would be able to do.
Yeah. Now let's talk geographies. We had a very interesting conversation before we went on air a couple of days ago about your views, which are fairly trenchant on various different geographies. You talk very specifically about the fact that you need to protect your downside.
Yeah.
Tell me about your view on the different sort of geographies around that you like and you don't like, and what are the characteristics that you have found difficult to deal with in different jurisdictions?
Yeah, so from an EMEA perspective, I think if you tier it, you'd say that the UK is probably the best. For exactly the reasons we just went over. Your ability as a secured creditor in those jurisdictions are very strong, and your ability to make sure that you can recover your money and sort of dictate the strategy is key. I'd say we've recently had an unfortunate workout in Holland, but that worked out exactly as it should have done. So Holland is also a reasonably good lending regime from an ABL perspective. We've looked at a number of things in the Nordics, where again that is pretty good, just generally, albeit there's not actually that much insolvency out there, or distressed stuff. And then you've got Germany as well, which Germany, I think it's probably the strongest of the sort of strongest of the weakest, if you know what I mean. So it's probably just slightly in its infancy in relation to ABL, and I know that there's a number of banks that can attest to that, because the processes aren't quite as established as they are in like the Netherlands or the UK, and also they're just slightly longer processes, which always commands a sort of deeper level of uncertainty around collectability and stuff like that. But I think Germany, somewhere we're happy to lend. We have lent into Spain, which is not normally one of the ones which people would associate with an ABL, but that's a very specific facility. It's a very focused inventory facility, where we've got control over the assets. But then you've got, you mentioned bad jurisdictions. France is a bad one. You can never get control of the assets there. Italy, very similar. It goes into a court process, so you can be there years trying and get the money back. So those are probably, like, at a high level, the jurisdictions that we like and then don't like, really.
Yes. And in Germany, I was a partner at White & Case for many years, and White & Case has a very strong insolvency administration section, and I thought it was a great business to be in a way, because the administrator gets to sort of get a percentage.
Well, I mean, it's basically the same as the UK, right? That's what hooked me in the first place, right? It's the ability to control the process. Like, I'm not going to say it's not ideal to have lawyers running a business, but it's just a nuance that you need to like understand a little bit better and communicate better.
Yeah, so in Germany, you have insolvency administrators, and that's their job. You know, they do it all the time. They're very sort of focused on sales process, and they tend to sort of operate by getting a percentage of the proceeds. And there sometimes can be a bit of a tension there between, I guess, some of the Anglo-Saxon viewpoint, which might be to do a holistic restructuring, and the administrators who just say, no, I just want to sell this asset. And
that's some of the interplays, right? Like another good jurisdiction for that is Belgium. Belgium, not a great jurisdiction to lend into from an ABL perspective. Like no matter how many lawyers I speak to, for us as a secured lender, or how we look at underwriting, you need certainty associated with process. And Belgium, for example, it just doesn't have that. Everybody always talks about pre-packs to me there, which is fine. And obviously, we're very used to doing pre-packs in the UK, just generally. But the question is, what happens if there isn't a pre-pack as an option and you're doing a trade out? To which the answer is, oh, that's not very good. Can you not pre-pack it? Which is unfortunately not the basis that we underwrite things on, because you want to be able to ultimately, in a worst case scenario, we'd like to be able to sort of like fall back on our asset knowledge so that we can realize the assets for the value that we think it is, because that's what's underwrite the whole deal, basically.
Yes, yeah. And I think I've talked in different episodes about what pre-packs are. I had a good episode with FTI, Lisa Rickleton, where we went through it. But in essence, for those who haven't heard that, it's just the management itself negotiates a sale process outside of an insolvency. Right at the last minute, the insolvency administrator goes in and sells the asset to the person offering the best price reasonably obtainable at the time. So that and you get, if you happen to have the debenture, the decision as to who the insolvency administrator is, and so you can be comfortable that they're going to be a sensible operator.
Pre-packs are a great tool, right? Especially in the UK market, where in a worst case scenario, Poundland probably would have gone through a pre-pack if it wouldn't have gone through the process it is doing, because you exhaust the market in relation to it. So therefore, you've got a solution which unfortunately involves insolvency. You work out what the potential exit is in relation to the business that will go forward and what will not. Agree that with the proposed administrator, and then everybody goes their separate directions. Is the idea. So you provide a huge amount of certainty to employees and continued employment. So, and you've got a plan, most importantly, which I always think of restructuring, you'd probably need one.
Yeah. Well, I suppose the other thing is that you're not in an insolvency process for months and months and months, where suppliers, employees are just losing confidence after each day, and before you know it, you haven't got much of a business to transfer.
I mean, as you say, the longer you trade in admin, the more the value dissipates. It certainly isn't value accretive normally, unfortunately. So, as you say, it tends to be a good solution. However, I'd be remiss to say that there's been good examples recently. The Body Shop, FRP did a great job trading that for I think it was like almost 8 months in the end before the sale to Aurora. So, there has been recently a couple of longer term trading solutions where actually there's been great solutions. I mean, my old shop, Homebase specifically, they've managed to get the sale away to the range, which is a great result for some of the home-based guys as well. So, and that was a more protracted sale sort of trading process. But it feels, as you say, normally a trade is not trading through admin is not value accretive.
Yes, yeah, and Poundland itself was a pre-pack, was it?
No, we never pre-packed it. So just to be clear, so there was no pre-pack. We bought the file. It was a completely solvent purchase. We did, however, go straight into a restructuring plan, or we launched a restructuring plan literally the day that we bought the business. To use the earlier phrase, we done like a pre-restructuring plan We basically just did it from day one, which we're currently going through. So, I think specifically that the restructuring plan on Poundland, there's various reasons why we did that. And it'll be interesting. I mean, we're completely supportive of the business, obviously, and of Barry and the team. From a management perspective, I think the proposition change that's being proposed on that is the right thing to do. And unfortunately, the store estate is somewhat a little bit bloated, so there does need to be a little bit of a change in relation to that. So unfortunately, we will need to exit some stores, but hopefully, after the court's action, which is the 26th of August. Then we should be hopefully the company will return back to a sort of more stable footing, and we'll be looking to exit, hopefully.
Right. And obviously the process is ongoing, so I don't want to sort of draw you too much. So, but let's just talk in a sort of hypothetical here. When you're looking at a sort of situation where you've got a lot of stores, you need to reduce the estate. Perhaps there may need to be some changes to the leases, etc. Can you sort of take us through some of your thinking about when you're seeing a situation like that? Why would you use a restructuring plan, say, versus a CVA, say, versus a scheme?
Yeah, so very rarely would you use a scheme, I would suggest, in those sort of scenarios, just generally because a scheme would suggest that there's sort of a solvent solution, which doesn't involve sort of mitigating large liabilities. The key reason that you look at a CVA versus or an RP is because in those specific examples, retail examples, you've probably got considerable dilapidations associated with dealing with the retail estate. So as part of that, you probably want to try and move some of that away from the business. So that doesn't tend to work under a scheme. So on an RP versus CVA, look, this is first. I've done many CVAs. So CVAs I feel very, very comfortable with. I've not done. This is my first RP, but there hasn't been that many in the market just generally. I can say more generally, I think restructuring plans should provide more certainty in relation to the outcome. As Rob Russell would say as well, today RPs haven't failed as well, as in a company going through a restructuring plan. There has been a very low failure rate post that. You can't say that necessarily of CVAs at the moment. My counter to that would be there hasn't been that many RPs, so therefore there hasn't been that many go through that have lasted the length of time. But time will tell, and I do agree with him that RPs do provide a considerable better opportunity to shore up the balance sheet. Because obviously you can deal with secured creditors as well as unsecured creditors as part of it. So in that, guys, there's a really good opportunity for businesses which have difficult cap stacks to deal with them through RPs. I think the other comment I would say is RPs probably are much more expensive, goes without saying, just generally. So you tend to need to be of a certain size. I know that there's a lot of people trying to do mid-market RPs, but it's still very, very costly exercise, unfortunately, until the market's done a load of them. I suspect that won't change for a little while. But CVAs, obviously, when I say certainty, CVAs, obviously you've got various different thresholds that you need to make in relation to getting the votes through, whether it's 75% of the overall creditors or 50% of the unconnected creditors. And it's just making sure that in certain circumstances that may not be something which you can really control or really feel like you might be able to sort of make it good inroads or certainty in relation to it. So that would be things where you've got multiple, let's say thousands of creditors where you have to go round them, where there isn't huge, big creditors which you could probably just speak to directly and just get their opinion. Because as we all know, in those sort of situations, if you've got multiple different creditors, all of smaller votes, it's very difficult to predict in those instances which way it's going to go. So
yes, yeah, I mean that's a good point. I mean there's a a numerosity requirement in
It's on the thresholds.
Yeah. So just to sum that up, you've got cross class cram down,
That's easy for you to say.
which I struggle with in a restructuring plan, which you haven't as much in a CVA. You've got the fact that you can bind secured and unsecured in a restructuring plan, the voting we talked about. And also, I think you've got probably it's a greater court consideration. And so once you've got that stamp after a lot of, a couple of hearings, you probably know that the plan will hold up. Having said that, we have had a few.
It's not the
we've
same
had a few sort of problems.
Judges, as you rightly say, like it's the judges and QCs obviously do a huge amount of work, working through all the, as you say, like looking at the specific case information, which I appreciate the CVAs are a court process, but that isn't the same. They get stamped. That's what happens. Obviously, you've got your supervisors and your nominees there, which are court-appointed officials. It's not quite the same sort of independent rigor in some ways.
Yes. Well, it sounds like we're halfway through the process on Poundland. So good luck with that. Are there any other interesting cases that you sort of have been involved in recently or are looking at the moment?
Probably not that many that we can discuss on the call at the moment. I think what I can say is the market. There's just such a lot of uncertainty in the market. There's a I think Gordon Brothers and our competitors are in a really unique situation where we can where there's uncertainty, we can probably provide certainty in relation to potential value going into businesses, which I think sometimes there isn't that. So hopefully simplifying things from a director's perspective to understand what their options are available to them. It's easy for me to say that the earlier that we're brought into situations as a firm, the more likely it is that the company will survive. I'd say we do tend to be brought in quite late into processes nowadays. As a result, the companies probably don't have that many levers left over to sort of turn. So they're on sort of last throw of the dice, really. So, and as I say, we're happy to try and give them that last throw, and because predominantly we're underwriting based on asset value, but it's always a bit of a shame when companies do go into a process that's not ideal for obviously ourselves and also the workforce and everybody around it. So we like to try and work with banks and advisors early to try and see whether there's potential other ways that we can deal with things, whether it's through selling off assets separately through solvent means, or through moving around assets, or just thinking about things slightly differently.
Well, I've sort of lost count of the times where I sort of think, I wish I'd heard about this particular situation, 6 weeks earlier, because you often do get a call of, we can't make payroll on Wednesday or something. You think, well, it's
what do you want me to do?
Yeah, you're in a difficult spot there. So it sounds very self-serving for both of us, but I think call your professionals and your potential lenders earlier rather than later.
It's always like, I appreciate that there's propensity, especially with within companies, for people to be very positive, but sometimes it is worth just understanding what the downside case would be and just playing that through a little bit, even if it's just for your own peace of mind as a director, just to understand what that is, because sometimes, and especially in the world that we're in at the moment, I think you're going to increasingly see banks take a view, probably more negative view in relation to performances, and the problem is once you end up going down in that snowball, it's very difficult to turn yourself out unless you've had good advice going in to say, actually, this is what they're looking at, these are the things you need to focus on in order to turn it around. I mean, the best example would be retail, where if a company starts performing badly, there's a propensity for them to start marking down and offer everything on sale. Well, that does a couple of things. That obviously knocks down your overall value of the stock to any lender, because that means that you're effectively putting a blanket discount across the stock. So therefore, your ultimate returns in relation to that will be lower. Therefore, your borrowing base gets lower, and unfortunately, it just becomes a downward trend of which is very difficult to pull out of. Whereas, if you speak to the lender, say actually, performance isn't going very well, but we're going to isolate this group of stock which is underperforming and specifically try and discount that at a more aggressive rate than the rest of the estate, and this is the sort of thing, then they'll be able to carve that out or specifically take an allowance for that instead of taking a more holistic approach in relation to it. So I think it's things like that where we sometimes talk about it's like gaming the system a little bit. But it's not really. It's just understanding how people look at the system and just looking at how they're assessing it and just using that to your advantage to try and turn around a situation. Because I mean, like I've seen it loads of times, and I've been involved in a couple as well. Like a turnaround is hard. They're really, really difficult. It takes a huge amount of management sort of focus. Huge amount of efforts involved, and to me, it's all about having the right advice in relation to it, and also just understanding what you're trying to get to as a solution instead of just hoping that it'll all become good again, basically.
Yeah. Actually, it occurs to me, I haven't sort of talked to you about this before, but you must come across credit insurance quite often.
They always pull like as soon as everything goes bad.
Can we talk? Can you just describe what credit insurance is, perhaps, and then sort of describe maybe how you've interacted with it and maybe turned around a situation?
Unfortunately, I can't give that many. It tends to be the death of a company when credit insurance goes. So credit insurance is effectively, so if you've got suppliers into the business, there will be potentially a credit insurer which will say, hey, we'll insure all these creditors to a certain amount of terms. So it'll be whether it's 120 days, whether it's certain credit limits, etc. So effectively, those suppliers will sit there and go, hey, I've got an insurance company that in a worst case scenario, this company goes bust, they'll give me the money. Or so they think.
Yeah.
What actually happens in reality, in my experience, is it's all based on covenants and just general. It's going to be the sort of thing that AI is going to absolutely take over. Basically, I have no doubt, because it's all based on looking at the last sets of accounts and all of the latest sort of financials that are available, and then taking a credit view in relation to that. The problem is, obviously, in the things we're talking about is where there's a turnaround situation. The credit rating is obviously lower, it drops. And as a result of that, liquidity unfortunately drops out of the business, because you'll have suppliers that, let's say they've got a £2 million credit limit. Their insurer says, actually, because of the company performance, it needs to be £1 million. And therefore, the company that's just experienced, unfortunately, a little bit of rough time trading, then has another £1 million that it needs to throw out the door in order to make sure it works from the supplier's perspective, because they'll be wanting that to happen. So it tends to be a bit of a death spiral, because obviously the more money you put out, the less likely it is to do a turnaround, and it's not as if you're buying new stock with that. You'll by virtue of the fact you're just paying for all the stock which you've already had. So it tends to be, unfortunately, when the credit insurers get involved, it tends to be something that ends up being a bit of a death spiral if it starts going wrong.
Yeah. It's interesting you were talking about the possibility of AI sort of helping with presumably the analysis of that. What do you think of the future of investing in your sector? What do you think technology is going to, and just market forces generally, is going to affect you in the next few years, or how will it affect you?
I think it's going to be a really interesting one. I think the problem with distressed lending specifically, and the reason I don't think AI will be the solution anytime soon, is it's always very nuanced. And nuances are very difficult for AI to pick up, just generally. Like by virtue of the fact it's a nuance, it means that there's not normally that many situations which you can look at as a comparable to the previous time and say, actually, this is going to be how it works, which, as I understand it, is how AI predominantly predicts its results, albeit there is a little bit of machine learning there going on in the background, but that nuance is pretty difficult. I think for more, I always think like mortgages, for example, just normal mortgages. That's an area where I think AI could absolutely revolutionize that sector. Just generally, I mean, we've all unfortunately probably dealt with surveyors and everything like that. That just feels like a way where you could probably, all the searches can be done and AI can be just like generally focused in on this is the paragraph we need and this is the right. Just pull out that information, spit into a report, and jobs are good in. But I can't see that being the case in sort of distressed lending. I suspect as we move more towards an AI-driven world, I suspect that probably there'll be knock-ons on financing just generally into certainly smaller financing, PCP and things like that, and then it'll probably start moving into more just normal loans, specifically UK where it's pretty well established system. I think it's going to take a little while. Is my personal view, but and I'm sure maybe this will age really badly, and there's going to be loads of like private credit AI funds, but I struggle to see like how that's going to be possible to deploy money on the back of that, because fundamentally, it's going to come down to who's actually underwriting it. I think so. You'll always be reliant on somebody like a Gordon Brothers or somebody from a valuation perspective to understand what the value of the assets is fundamentally in order to underwrite the deals. So.
Yes, yeah. Now we discussed Germany, UK, probably your two biggest markets in under your tutelage. Can you say something positive about our future, because we're in a sort of bit of a sort of low growth spot, but I mean you are deploying capital, so always, you must have some confidence in the future.
I don't know whether I can say anything positive, unfortunately, but I think there will be winners and losers, right? Like I think it's all about positioning and understanding what the markets is, and there's a huge amount of luck that goes into these things as well. I must say. So, I'm sure that if somebody invested into a fashion retailer going into COVID, they probably had the best business case ever. But unfortunately, with COVID, nobody bought any clothes anymore. Whereas if somebody was investing into the DIY sector, for instance, at that stage, great opportunity. So I think there's always opportunities. I think it's important to, in a doom and gloom sort of environment, I think it's always important to just make sure that you sort of look at the positives. You're breathing, you're enjoying your work. The UK is reasonably stable. I know inflation is slightly getting to us a little bit, and I know there's a lot of people struggling out there, but compared to some of the other jurisdictions in Europe, there could be a lot harder places. I think it'd be really interesting. I mean, we've already touched on it, to see how we do with AI, just generally within the UK, because I think that there's a big misnomer in relation to how many jobs potentially could be lost in relation to it, because fundamentally the work of AI still needs to be reviewed by people. So it's just, I mean, it's one of the things I think is really strong about the UK is our ability to sort of up spec and sort of learn specific markets. I mean, we're one of the biggest financial services countries in the world, and that having that sort of knowledge within it probably suits us well for an AI world where you can start sort of building up that sort of expertise.
Yeah, and actually, I'm going to pick up on something you said before in our discussion, which was that we do have a lot of really great tools now to deal with. We've got the CVAs, we've got the pre-packs, we've got the restructuring plans, we've got the schemes of arrangement. So if there is an opportunity, if there is a turnaround, it feels like you've got the money, we've got the tools, that there is sort of something to be done here.
Yeah, I mean, obviously, and that's where that's where we hope we can help in those sort of situations where other people probably are shying away from it because it's just too complicated. Well, we love complicated deals within Gordon Brothers. It's one of the things we do really well. But how we do complicated deals is we boil it down to the simple stuff where we focus in on the assets, use our asset knowledge to understand how that will work through, understand the structure, and then everything else is sort of just noise really from that perspective. So you can provide that sort of base level of comfort in relation to those scenarios, and then hopefully what that allows is allows management to focus on wider things and the bigger issues to turn the business around.
Yeah. Well, I think we're going to leave it on that incredibly positive note. And I wish you every good luck in Poundland and all the other deals that you're likely to come your way in the next few months. So thank you, Nick, for joining the show. It's been really it's been fun.
No worries. No, thank you, Stephen. It's really appreciated it. Thank you.
Cheers.
Cheers. Thank you.
You've been tuning in to the Turnaround podcast with your host, Stephen Phillips. You can find this show on all the major platforms, including YouTube, LinkedIn, Facebook, Apple Podcasts, Spotify, and on our website, freilibertas.com. Thank you for your positive reviews, comments, questions, and for sharing this show with others.